Welcome to the channel. For those of you new, my name is Dave and I work in financial services. And these videos give people hope and ideas to build a sizable portfolio over six figures. So if I can do it, you can do it. Now, I do have a workplace pension, but I'm restricted one contribution to working less than money. So I've got what we call a self-invested personal pension plan. So this is my review for June 2026. Now, so what are the aims? Well, annual growth of 10%. Annual dividends this year of £7,500 and a year-end value of £231,000. So how have we done the month? Well, the month of 212940, we finished at 242806. So in the month, nearly £30,000 increased value. Now it was distorted because we've done a transfer in of £22,500 from our current scheme, our old pension provider, so we simplify the pots. But year to date, we're up 13.14% for the first 6 months. So we put contributions, first of the month, automated £100, and the government gives us tax relief, £25 free money. So our platform providers charges fees of £23.02, based upon % of our value. And where exactly are we invested? Well, at the moment, UK and Europe, 73%. USA and Americas, 24%, and Asia and American markets, 3%. Now we are putting additional funds into, shall we say, global tracker funds to reduce allocation to UK, but it will obviously take some time. And all dividends received is reinvested within UK funds to grow dividends. Now, let's look at what we received the month as the form of dividends. Well, quite a good month, £606. Legal and General, a year around 8%. Gave us nearly £400. 141 new shares reinvested, so dividend increase and next payment. AG Bar, the drinks provider, gave us £27.79. HSBC, £100 as a quarter dividend reinvested 6 new shares. AJ Bell, the platform provider, gave us £13.5p. And BP and Shell gave us quarterly dividends, £33 from BP and £44 from Shell. So our yield across our shares have got 4.56%, slightly reduced because the funds or the shares were up in value. But we were expecting 3750. We've received to date nearly £4,500, so well above expectations. Now we will have good months, bad months with the chart, but let's just say £600 a month is very pleasing, so as it win the portfolio, and it's all going to be reinvested to grow dividends in future years. Now let's look at, shall we say, what we hold in the portfolio. First we'll do our funds and then we'll do our shares. At the moment we've simplified our funds. We've owned 2 funds. £62,000, 30% of our portfolio, both in profit. We own a Fidelity Word Exit Fund, nearly £36,000. Fees of 0.12%, giving us a return each year of 10% year on year, past few years, but last 12 months it's over 26% profit. Now it makes up nearly 15% of our portfolio, but it owns around about 1,400 stocks, so we say, but very low fees done to the diversification. Our other fund is a legal and general technology fund, 11% of our portfolio. Higher fees around about 0.3%, does pay a small yield, but around about 250 stocks, but £26,500, 11% of portfolio. Okay, but last year to date, up 50%. Who knows what in the future, but very good returns. But our tech stocks overvalued. But we've done it for a reason, diversification. Now, let's look at, shall we say, the funds we hold in our portfolio. At the moment, we own 12 shares. We did own 15. We've made some sales because we want to, shall we say, disinvest some money very soon towards a property purchase. So we've simplified our portfolio somewhat. But 10 in profit, 2 small loss. Our holdings are worth £141,000, 60% of the portfolio, of which mostly is in the FTSE 100. Now, our largest holding is Lloyds Banking Group, nearly 40,000 shares, £44,000, 18% of the portfolio. But a very nice yield, so I say very good results, paid a nice dividend in May. Okay, very cash rich, shall we say, because of upset interest rates, very good profits. We own Aviva, 5,496 shares, £36,000, 14% of our portfolio. Again, very nice yield, 6 to 7%, very cash rich, dividend increased, share back increase. It's on a buying spree, recently bought direct line. We own HSBC, 1,355 shares, nearly £20,000, 8% of the portfolio. Has had a great run recently, shall we say. Does pay a nice quarter dividend, as we found out, but obviously done for everything away from the UK banks. We own Barclays, 3,352 shares, £17,000, 7% of the again, a year around about 3-4%, very cash rich, very good result, shall we say. Who knows how it goes, but a very nice yield, very nice return rating. Now, we own Legal & General, 614 shares, £7,500. I present night of the month, but a yield or year around 8-9%, but it makes up 3% of the portfolio. It was the, shall we say, possible takeover target, seems to have fizzled out recently, but what will happen in future months? Now, we own Shell, 150 shares, £4,500, nearly 2% of the portfolio, and BP, 542 shares, £2,500, 1% of the portfolio. Very good results lately because of obviously what's happened, shall we say, in the Middle East conflict, but who knows what will in the future, but it does pay nice quarter they found out in the month, okay? They are going to renewables, but they're both very cash rich. Now, we own Sainsbury's, 1,413 shares, £4,500, 2% of the portfolio. Forever in a price war of holding, but everyone needs food, affected by cost of living, shall we say, increased costs, but it will pay us a nice dividend, around about 3-4% in early July. Now, other company we own is Penn and Water Company. It struggled recently. It got a recent fine, but it is making a profit. It is increased dividends, but it's hampered, shall we say, by bad debts and infrastructure costs. We own AJ Bell, our platform provider. What we see is a growth company. Assets are being increased substantially. Clients are being increased, whether it's on a platform, self-investing, or it's through advisors. But a growth company, and it will pay a nice dividend in July. We also own JD Sports, okay? Has struggled recently because of what happened to Nike, but it makes £1 billion profit, a growth company, and it will pay a very small dividend at the end of July. And finally, we own Card Factory. Has struggled in the high street, but it makes a nice profit. It is expanding, it is opening new shops, but it's impacted, shall we say, cost of living crisis, wage increases, inflation. Okay, but again, it will pay a very nice dividend in July. So we see no reason to sell any shares for the future. Now we've sold them recently, Drax, okay, Greg's, okay. We've done it for a reason, we need to take some out of the pot of money, but we weren't going to disinvest more funds. We've done it from shares, but we sold them at nice profits, okay, but we've done it for a reason, we need some money. But it just goes to show, if you invest on a regular basis, you think long term, you get in the habit, or in a tax wrapper, you can create a sizable portfolio. Now, if you like the videos, smash the like button, subscribe to the channel, look at my blog, moneyminted.co.uk to reach your goals. And we'll see you again in the next video.